We have been running these sessions with Blue Wealth for a while now. Today we're featuring Tony and Gavin from Blue Wealth, and they're really here. If you're looking to make smarter property decisions, you've come to the right place. For those new to Blue Wealth, they specialise in helping investors make informed decisions and based on research. They cut through all the media noise and really focus on facts, long-term data, and market trends in the ways that they make decisions and advise their clients. And they've helped countless of our clients, but also countless clients around the world build wealth through property. Gavin presents a really strong case in what happens in the Australian market in terms of the economy and all the data behind it. And I have now heard this presentation, I think twice in the last 3 weeks, and have enjoyed it so much that I've asked him to come and present it to our clients and our contacts. So I don't want to take any more time up. There will be a Q&A at the end. We'll answer any questions you put through at the Q&A button. And also we're recording it. So if you can't stay for the whole time, we will send you a recording of the...
No one wants to leave, surely. No one will want to leave.
So over to you guys.
Thanks, Nick. G'day, everyone. I'm a big fan of Motion, being a client of theirs myself. Of multiple properties in and around Melbourne that Motion manage and manage very well. So a lot of you, like me, always want to know what's happening in the market, what's happening in the economy, what's going to happen with interest rates. Has the 0.25 had some sort of impact on the market? And will further interest rate falls have a further impact on the market? I know most of you are in Melbourne, and certainly the sentiment around the Melbourne market has been quite negative. Your government, regardless of which side you bat for, Labor or Liberal, certainly made some mistakes over the last few years that have put the state in some precarious positions, and that's certainly had an impact on the property market. Because at the end of the day, property markets are a reflection of the way people feel about their market. So I'm going to do a bit of an intro, and then I'm going to hand over to someone younger, smarter, and better looking in Gavin, who's going to take you through the economic update, not only nationally, but internationally, give you a bit of a taste and a flavour about what influences the decisions that we make around where people invest and why they should invest and when they should invest. And what Nurit asked me to do was to give everybody a sense of why us. Why am I sitting in front of you as somebody who is a perceived expert around property and property markets? I'll give you a little bit of my background. And I suppose for me, what I've been doing this for 25 years, and what I like to say to people is that if I can do it, anyone can do it. I'm the son of ethnic immigrants. I was born in Melbourne. I was born in Carlton. And my parents immigrated to Melbourne in the late 60s. My dad in the late 60s, my mum in the early 70s. And over the years, I've learned from people who knew more than me and took action, and have ended up in a place where I've been able to build financial security for myself and for my family. So a little bit about me. I was born in Melbourne, as I just said. I was raised in Western Sydney and educated in Newcastle. I failed my HSC, which in Victoria, I'm pretty sure, Nurit, you can nod, is the VCE. So I was forced to go to Newcastle. It wasn't by choice. I got myself on track, and then I've created my own personal wealth through property. And one of the things I'm probably most proud of, and I need to change that number from 22 to 23, but I have bought at least one property every year for 23 straight years. And why is that important? The impressive part is not the numbers. Yeah, it's not the 22 or 23. Yeah. What is the impressive part of that when I reflect on my life is the fact that I did it through all the noise over all those years. I bought property through recessions. I bought property through global financial crises. I bought property through COVID. I bought property through increasing interest rates. I bought property through the Trump administration. So There's always 1,000 reasons that someone will give you about why you shouldn't buy in any particular market. And I've been deaf to that noise, and I've made decisions that have benefited me and benefited my family over the years. So now I own 36 investment properties over 5 states. And what we're going to teach you today may not lead to you owning 36 properties over 5 states. But if you own 1 more than you would have, or 2 more than you would have, then we have potentially changed your life. If you'd bought a property, for example, like some of our clients in Perth 2 years ago, you'd be $300,000 or $400,000 wealthier today. If you'd bought a property on the Sunshine Coast, like some of our clients did, you'd be wealthier than you are today. The property market is the Australian property market, and the research gives us an idea of where we should be buying and why we should be buying there. As I mentioned at the beginning, 25 years industry experience, and I'm very grateful that we've helped almost 10,000 clients invest and educated well over 100,000 people. We can now add you guys to those numbers. For us, everything starts with the knowledge and the education. My team, where do we fit in? There are 25 of us. You're about to meet Gavin when he takes you through the economic update. We turned 16 years old in January, so Blue Wealth was started on the 12th of January 2009, which was during the GFC. Our job, my team's job, is to hold your hand through the process, through the money-making process, to ensure that you're buying good assets and you're holding them for the long term. We have won many national awards, the business and my staff, and it's where the industry refers their clients. Lots of brokers, accountants, financial planners refer their clients to us. So our job is to make sure that we're identifying the best property in the country for you to buy, and most of the time that is before it hits the market. So we've got a lot of experience doing that. We've helped a lot of people make a lot of money over a lot of years. So the research, which you're about to hear from Gavin about, is about buying the right property in the right market at the right time. So we use this research model. I'm not going to go too much into it in the interest of time. But while you hear Gavin talk, you will see that there is a very clear methodology that we use to approach property investment. So as I've just said, using that research model, we've made a lot of people a lot of money over a lot of years, and that's what we will continue to do. So today is about the economic update, the Australian economy, how it's affecting the property market. Can you afford to ignore the information? Will the information help you to take some action? And then we'll do some Q&A at the end. Okay? So it's nice to meet you all. I will hand over now to that younger, smarter, more handsome version in Gavin Chau, who is Blue Wealth's Senior Research Analyst and has an incredible knack of understanding how markets work. And I'll see you at the other end. I'll hand over.
All right, thanks for that, Tony.
Are you going to use the mouse as well?
I will use the mouse.
Yeah.
Okay. I'm going to go as fast as I can. We have a limited amount of time and a lot of stuff to cover. So, all right. So we're going to talk about the global economy. Australia doesn't operate in a silo. It does. The world is very interconnected now, and things that do happen around the world affect us as well. Of course, we'll talk about the Australian economy, the Australian property market, and everyone's favorite part, what happens in 2025. All right, so there's a few dominant themes for 2025. The global economy, the global economy is stalling. So there's widespread pessimism about the economy, and it's not just in Australia, it's everywhere around the world. We'll talk about Trump, of course. And as I'm sure you all know, there's an affordability crisis in housing. And all this means is stimulus is incoming. So the central banks around the world, when the economy is slow, they'll do one of two things, or sometimes both. They'll either print money, which they call quantitative easing, or lower interest rates. And that's like giving a sugar hit to the economy, and it sort of boosts things up, but it has some unintended consequences, which we'll have a look at as well. There has been sector rotation into low-priced property. So this is probably the first time that we've seen this, where people are simply getting priced out of the higher end of the market, and they're sort of hunting the lower end of the market, and that's driving up those prices there. All right, so the global economy. So central banks around the world have cut rates 153 times in 2024. Now, if you compare that to the pandemic here in 2020, there was 162 rate cuts. So what does that mean? It means that the market has really treated the current economic conditions like a pandemic. Yeah, so there's widespread pessimism. You can see really how bad things are at the moment. And all this means is that more stimulus is incoming. So as we just spoke about, when the economy is bad, they stimulate and try to fix it up. If we look at China, China's had a property collapse, Evergrande collapsed. It's a huge development company, and its economy is in pretty bad shape. So they're currently struggling with deflation, and deflation is simply like falling prices everywhere. There's no demand and there's falling prices. So there's a huge youth unemployment problem, and they have a range of issues with the economy. This graph here isn't property prices. It's actually just general prices in the economy. You can see that they have fallen below that zero line. They fired the stimulus bazooka. It hasn't worked, which means they've printed money. They've cut rates, but it hasn't been enough to drag them out of this slump. So what does this mean? It means that they're going to bring out a bigger bazooka, basically, and use that, and they're going to cut interest rates even more. They're now facing 6 straight quarters of deflation, which means stimulus is coming. If we look at gold purchases, central banks have ramped up their gold purchases. And I'll tell you why this is significant in a second. It's the third largest net inflows to central banks. So, the RBA and central banks are similar to that. Federal Reserve, the People's Bank of China, and so on. They're all buying gold. Gold prices have pumped up 30% as a result of this over 2024. And what they're doing is they're preparing for currency devaluation as money printing resumes. So QE, or quantitative easing, is simply money printing. They create money out of thin air, literally. They press some button, money gets created. But that has an effect. So, if they create money and it flows through the economy, it doesn't flow through the economy evenly. So, there's like a hierarchy by which this happens. So it first flows into asset prices, and asset prices rise up, things like shares and property and so on. And eventually it has a way of filtering through into consumer prices, which is then measured in the CPI. Just as a side note, that CPI measurement that all the central banks use and all the government economists use is wrong, because it doesn't actually include asset prices. It only includes consumer prices, which means that the government assumes that you don't want to own anything that a rich person wants to own. I don't know about you, but I certainly want to own things that rich people own, like houses and art and shares and so on. So if you print money and create more money in the economy, what does that do to the amount of money that you have in a bank? It doesn't actually drop the money in your bank account, but it makes it less scarce because there's more of this money floating around, which means that your purchasing power declines. So the amount of stuff each dollar can buy falls. We see this effect as increasing prices. You may have noticed that fuel prices are up, electricity prices are up, food prices are up. I often use the example of a Big Mac. It was 70 cents when it was released. It's now like $6 or something. And the size hasn't increased. A lot of people say it's decreased. I've done a deep dive into that. I cannot figure out the answer. The value of the Big Mac hasn't increased. It's not 70 times more nutritious. It's not 70 times bigger, but it costs 70 times more. So why is that? The value hasn't increased, but the cost has increased. It's because that the purchasing power of the dollar has declined by 70 times. Gold, however, doesn't decline as it's an asset, and as you print money, gold prices go up. So it goes up by the amount that they print. Yeah, so basically the central banks are about to print money and they're buying gold to protect themselves. So anyway, so that's a good sign that more stimulus is coming. If we look at the US banks, they're in a risky position. These are unrealized losses. You can see here. An unrealized loss is it's largely real estate losses in the office space, in the office sector. As a result of the pandemic, people started working from home. They largely have not come back to the office. And a lot of office spaces have declined, or office buildings have declined by 50%. But the mortgages haven't declined. And in many cases, these mortgages are now higher than the value of the underlying asset of the actual office space. So it's an impaired asset. And so there's a bunch of this stuff sitting on US banks' balance sheets. So unrealized losses have hit like about $1/3 trillion. They've seen now 12 straight quarters of unrealized losses, and that is the worst since the GFC. It's actually worse than the GFC. The GFC is back here. You can see how much bigger that is. And all this means is that QE, quantitative easing or money printing, will need to return. They're going to have to bail out these banks. How they're going to bail them out? They're going to print money, recapitalize the banks, and bail them out once again. I first started talking about, this was first used in 1987 by a man called Alan Greenspan, who was the chief of the Federal Reserve in the US. And they called him the maestro. He was so successful at fixing these kind of economic collapses that they called him the maestro. So he'd do the same thing every time. He'd drop interest rates and he'd print money, and it would spark off this economic boom, and the crisis would disappear. So this happened in 1987. I did not pick up on it at the time. I was in year 4. But by 2006, I started talking about it, and even then, it was a very fringe topic. Nobody knew what QE was, nobody knew what it meant, and everyone thought you're kind of crazy. But now the world is sort of starting to catch on, and it's become a bit of a dirty word, because QE, this money printing, it has all these other consequences. Like the money flows through, pumps up asset prices, but anyone who does not own asset prices effectively gets robbed, because, as I said, if you print money, your purchasing power of your money declines. So if you're just a saver and you have no assets, you're effectively getting robbed, because the amount that you can buy with your cash shrinks over time, like a melting ice cube. But anyone with assets gets wealthier. So we see this growing wealth divide that in pretty well in all industrialized countries. So it's like a giant wealth transfer from savers to asset owners. So they may not use QE as the normal mechanism. They're going to use some other back channel QE because people are starting to realize what it is. It's become heavily politicized, especially in the US. All right, so everything we've been talking about points to this graph. So I want you to take a good look at this graph. Yep, it's very beautiful, isn't it? So it's a graph of global liquidity, and global liquidity is simply the amount of money sloshing around the system, and it's a measure of how much money printing has happened. So it moves in these beautiful 4-year cycles. But what do we notice here? Since 2023, it's moved into an upswing, and it'll probably peak somewhere in late 2026 or early 2027 or thereabouts. It may be a little bit earlier or later. It'll probably be a little bit later. And when global liquidity rises, it drags asset prices up with it. Global liquidity is simply a result of money printing. So as I said, the rich get richer and the poor get poorer. So we do see these terrible social consequences. But we're sort of forced to play this game, because we can't, if you don't buy assets, you're getting robbed, and if you do buy assets, then you get wealthier. So you sort of have to. You have to make a choice. As I said, the best estimate for the peak will be in late 2026 or early 2027. All right, Trump. Trump's a wild card. Nobody knows what he's going to do next. And sometimes I think he may not even know what he's going to do next. But like just recently, he's threatened 25% tariffs on Mexico and Canada and a 10% tariff on China. And a tariff is essentially just a tax that falls on the American people. Another word for a tariff is an import tax or an import duty. So if there's a 25% tax on Mexican imports, if you're an American, it means that anything that you buy from Mexico is now 25% more expensive. That gets passed on to the American consumer, and that 25% money goes to the government. Justin Trudeau, he quickly folded and he announced border patrols and a fentanyl czar. And as a result, Mexico and Canada's tariffs are now paused. Okay, so these tariffs, they would have cut US GDP, US economic growth, through to 2026 by 2%, and it also would have spiked inflation. So if you add 25% cost to an import, obviously that gets captured in the CPI calculation and inflation goes up. And what does that mean? It means that interest rates have to go up. So these would require an interest rate hike, just as US debt needed to be rolled over. So the US is, as a country, is in an enormous amount of debt. There's about $36 trillion worth of debt at the moment. And 25% of that debt would need to be rolled over in the first half of this year. You can see here, this is a graph of US debt since 2005. You can see that acceleration after COVID. So the US is really borrowing money to survive at this point in time. The interest repayments on this debt are now $1.1 trillion, which is more than the US defense budget. And the US defense budget is higher than the defense budget of the next 10 countries put together. As you can see, it's an enormous amount of money. And just to illustrate the pace of this debt growth, this is US debt since 1901. It took 215 years to add $7 trillion in debt. And then it took 4 years here to add the next 7 trillion. So these tariffs were never actually going to go through. They were always going to be a bargaining chip. Trump would say something outrageous and use it as a bargaining chip, but he never intends to actually put this thing in place. So the real question is China, and China is not so easy to bluff. So there's now a trade war between the US and China. The US currently requires China to import about $500 or $500 billion in energy each year, largely in the way of LNG, natural gas, and oil. And China says no, and they're going to place a tariff on US energy imports. And on top of that, they've announced export controls on these metals. And if you looked at the properties of tool steels or any like high-end knives or things of that nature, you'll probably recognize some of these names. So China's going to control the exports to the US on tungsten, of which China controls 80% of global supply. Tellurium, 67% of global supply. Bismuth, 80%. Molybdenum, 40%. And indium. These things are used in the defense industry and also in clean energy. They're very important to the US. And US exports, they make up 3% of China's GDP. So even if the US bought nothing from China, it would hurt the Chinese economy pretty badly, but it would not be catastrophic. China also controls many of the key US supply chains. It controls a lot of pharmaceuticals and just about everything. Like China makes about 33% of the things in the world, or 33% of the value of things in the world. It'll be the proportion of actual things would be much higher than that. And even the F-35, the most advanced fighter jet in the world, which the US has created, they rely on Chinese-made rare earth magnets. When the US found out that they were actually using Chinese parts in their most advanced plane, they cut these parts, and then the crash rate of the F-35 tripled. So it's very difficult to disentangle the supply chains around the world. All our economies are relatively interlinked. And this is the point where Trump will begin negotiations with China from. Overall, these trade wars, they're more of a drag on global growth. They sort of suppress economic activity rather than adding to inflation. And that means this indirectly affects Australia. If Chinese growth slows, China's our major trading partner. It has been since 1990. We sell, hard commodities there, which is stuff that we dig out of the ground, like coal and iron ore. But we also sell a bunch of soft commodities like wool and wheat and meat and things like that. So if Chinese demand falls, it slows our economy down as well. And all that does is it adds more to the case for interest rate cut in Australia. It either speeds up the pace of cuts or increases the magnitude of the cuts. So we either get deeper cuts or faster cuts. And all that means is that it's good for asset prices, even though it's not that great for the economy. All right. So in summary, central banks are cutting rates nearly as fast as during COVID. The Chinese economy has gone deflationary. It's in bad shape right now. Central banks are accumulating gold, which means that they're front running themselves. They're about to print money, so they need to protect themselves. It's the greatest insider trading move ever. And the global liquidity cycle is now in an upswing. So if you print money, the liquidity cycle is money. If the amount of money increases, asset prices go up, and non-asset holders effectively get robbed. The Trump trade war with China is a drag on global growth. And all of these things, if you looked at the totality of everything that's happening around the world, it points to more stimulus and higher asset prices. All right, the Australian economy. Okay, this is GDP. GDP is economic activity. We use it as a proxy for economic growth. You can see that it's either black or dark blue. I don't know how it appears on the screen. Those dark blue lines is economic growth. So you can see it's above zero, which means that there has been positive economic growth. But the real story is the light blue lines down here, and that's GDP per capita. So if you were to take all the economic activity in Australia and divide it by the number of people in Australia so that we each get apportioned a bit of this economic growth, you can see that we've either been flat at 0% growth or negative growth at the individual level and at the household level for 7 consecutive quarters. So what does this mean? It means that we've basically been in a recession for 7 straight quarters, and that's the longest recession in Australian history. Our economy really has been nuked. It's been destroyed by these high interest rates, and it's not really in a good shape. But the worst is behind us. You can see here that it's starting to turn up. It's becoming less negative. And hopefully in a year or two, we'll come out of this slump and we'll be back in the positive. If we look at the cash rate, and the cash rate is simply the interest rate that is set by the RBA, our central bank. It sets an interest rate, and then the banks add a margin onto it, and that's the margin that we pay when we borrow money to buy houses and so on. You can see that the cash rate has just dropped. It went from 4.35%. We had the fastest pace of rate hikes here, and now we've seen our first rate cut. It's the first cut we've seen in 4 years, and that's because inflation is falling faster than the RBA anticipated. The RBA just recently downgraded the neutral cash rate to 2.9%, which is somewhere down here. And what does that mean? So the neutral cash rate is the interest rate setting that the RBA thinks is neither stimulatory for the economy nor does it suppress the economy. So it's just a neutral level, which means that it points to like 5 further interest rate cuts from here. So we'll probably see interest rates come down a fair bit. They may bottom at 1.5% lower than where they are. And the first cut, if we were to look at history, the first interest rate cut after a hiking cycle is almost always followed by a second cut in the following meeting, which should be in April. So April should give us another cut, if history is any indicator, which will be good for asset prices. Now, the important thing to note here is that every single property boom ever in Australia has been preceded by a rate cut. A rate cut is the thing that starts off the property market boom. And straight away, we can see that the auction clearance rates, they've spiked 2% in a week. A week after this rate cut, auction clearance rates instantly spiked. That's a leading indicator for prices, and auction clearance rates, they have a very, very strong correlation with house prices. So you can see that the property market, even before these cuts have been passed through by the banks, the property market has responded. People are starting to buy stuff, and that drive up prices, which means that the bottom of the market is in. We have seen the bottom. Markets are coming up now, pretty much. All right. So in summary, inflation's falling, wage growth is softening. We've seen the longest recession in history. And it's really been government spending that's been keeping the economy alive in the past few years. And as I said, all property market booms have been preceded by a rate cut. A rate cut is the thing that triggers the start of a boom. All right, now to the Australian property market. Let's check out, I'm going for time. All right, affordability is worsening. We all know this. It's a quick kind of comparison between 1990 and today. In 1990, the average loan cost was $71,000, which is almost inconceivable, if we think about things now. The median household income was $27,000, and that was 38% of the average loan. We fast forward to 2024. The average loan cost is now $642,000. The median household income is 100 grand, and that's 16% of the home loan. So you can see that houses, by any conceivable measure, or property by any conceivable measure, is harder to purchase now than it was in 1990. The proportion of first home buyers are shrinking, and the loan market has really been dominated by refinancing. So it's basically people that already have home loans, and they shop around for different rates, and they switch lenders. But investor loans are also growing. So it's likely that first home buyers are skipping buying their first home and going straight to an investment, because it's cheaper, you can get rent out of it, you can get tax deductions and so on. And with the view that eventually they'll either sell up or move into their investment. And house prices keep outpacing incomes. So, if we talk about Hong Kong, that is the most expensive property market in the world, and it's a good kind of good way to look at the Australian property market. Sydney is the second most expensive in the world. You can see over time, average dwelling sizes in Hong Kong have shrunk. They're now at 45 square meters, which is about the size of a triple garage, the average dwelling size. And you can see also falling rates of home ownership and increasing rates of renters. So there's more and more wealth concentration into the hands of these people that have bought assets and are holding onto them. And we can see the same pattern in Australia. Although our average dwelling sizes have maintained the relative stability, they haven't really fallen. Average land sizes are falling. So we talked about a quarter-acre block. We used to talk about that, then it dropped to like a 600 or 700 square meter suburban acre block. And now these new housing estates have 300 square meter, so half that size of land again. We're also seeing a rise in units where we're spreading the cost of a single parcel of land over multiple dwellings. That's another way to keep values down. You can see Hong Kong is much the same. It's high rises everywhere, but those the prices just keep going up. People are getting locked out of the market. All right, so I'll go through this pretty quickly. It now takes 50% of household income to service the mortgage. If you compare that to the long run average, it was 36%. So it's actually very, very hard now to service a mortgage. For renters, it's also bad, but not quite as bad. It takes 33% of household income to rent, and that's higher than that 29% long-term average or 20-year average. All right, so how many homes are affordable to each segment of the community since 2020? So we're going to break this down into the top 25% of the wealthiest households, the median household at the center, and the bottom 25% of household incomes. So for the top 25% of household incomes, which is about around $172,000 a year, 80% of homes used to be affordable in 2020, and now only 50% of homes are affordable. If you look at the median household income, 50% of homes were affordable in 2020, sorry, and now 10% of homes are affordable. And for the bottom 25% of earners, 10% of homes were affordable in 2020, and now they've been locked out of the market altogether. So the rich get richer. So ownership will be increasingly concentrated in high income, high wealth households. The bottom 25% have been locked out of the housing market. And that's the effect of monetary debasement. If you print money and you do not grab an asset and hold onto an asset, you will eventually get your wealth eroded away. The number in your bank account might not shrink, but the purchasing power of that money will. So it's like it's basically sitting on a giant melting ice cube. Okay, if we look at property market growth nationally, it slowed over the course of 2023, compared to 2023, sorry. So over the course of 2024, it did slow down. It remained positive, but it slowed down as we expected, and that was the result of these high interest rates. And 2024 was really a story of affordability. Units outperformed houses. Regional areas performed very well. And the bottom 25th percentile, it's like the cheapest 25% of houses, outperformed the most expensive 25% of houses. All the housing shortage factors were still there. We still had a massive undersupply of housing. We still had a heap of demand. People still want to buy it, but people simply could not get the money to buy these houses. And so where they bought where they could, which was in the cheaper end of the market. All right, let's have a look at that as a picture. This is the capital cities, Sydney, Melbourne, Brisbane, LA, Perth, and so on. And this light blue bar here is the cheapest properties, the cheapest 25% of properties. This middle blue bar is the median property, and this dark blue bar is the most expensive properties. And you can see here, in every single case, the cheapest properties did better than the most expensive. The cheapest did better than the most expensive. Cheapest did better than the most expensive, and so on, and so on, and so on, and so on, and so on. All right. So let's have a look at the capital cities one by one. So this is a little bit of a hard graph to read. That's the zero line. As long as this orange line stays above zero, it means positive growth. If the orange line is heading up, it means that growth is accelerating. If the orange line is heading down, it means that growth is decelerating, but it's still growing. And if it goes below that zero, its prices are falling. All right, so let's have a look at Sydney. Sydney grew 27% since COVID. Its 10-year growth has been 68%. And over the past year, dwelling prices increased by 2.3%. If you look at Melbourne, I can't even see that, did 7.8% since COVID. It only grew 47% in the last 10 years. So it's lagged behind, and its long-term growth rate is as good as Sydney. So, that points to a relative underpricing in Melbourne. Over the last year, dwelling prices fell by 3%. If we look at Brisbane, it grew 68% since COVID, a massive spike. Its 10-year growth rate is 90%, so it almost doubled over 10 years. And it still did very well last year with 11% growth. They're currently at a record high. If you look at Adelaide, again, spectacular performance since COVID, 3-year growth, 73% increase. Its 10-year growth rate is now at 93%. It's basically doubled its prices in the last 10 years. And it did very well again last year with 13%. And they're currently at a record high. Perth, sit again. So Brisbane, Adelaide, and Perth have been the winners since COVID, 76% since COVID. Its 10-year growth rate has only been 55%. Prices actually fell there for 6 years after the global commodity super cycle. So after 2014, from 2002 to 2014, Perth prices spiked extremely sharply. China was building a city the size of Brisbane every month, and it was enormously steel intensive and energy intensive. And Perth or WA was selling an enormous amount of coal and iron ore and so on. And then they fell for 6 years straight, and then they started to recover in 2020, sorry. So the 10-year growth rate has only been 55%, but 76% growth since COVID. Over the last year, they did 20%. It's been a spectacular return, and they're now at a current record high. If you look at Hobart, since COVID, 26 or 27%. The 10-year growth rate, really good, 87%, but it has lagged behind this part of the cycle. Now, this is pretty interesting. Hobart dwelling values are now 12.6% below the record high, which in March 2022. Darwin, another very interesting market, only 25% growth since COVID, a negative 3% growth over the last 10 years. It's done nothing for 10 years straight. And over the last year, it basically did nothing, did 0%. And prices are 6.4% down since 2014. So we don't have anything in Darwin right now, but this is a market I'm keeping my eye on. If this swings, it could come up very, very nicely. Okay, Canberra's an interesting one, always the lowest unemployment rate, always the highest incomes. The government looks after itself. 30% growth since COVID, 62% growth in the last 10 years. Last year did nothing. And prices are down 6.8% since 2022. Okay, so if we look at rent growth has slowed too. So post-COVID, rent spiked extremely sharply. You can see here, nationally rents, they hit over 9%, which is about 300% the long-term average, and they stayed there for 3 years. So nationally rents in the capital cities, rents have increased around 50% since the start of COVID. The rental market is still very, very undersupplied, but tenants have simply run out of the capacity to pay. You can't increase rents by 50%, where your incomes haven't gone up by that much, and expect tenants to continue to pay that. So rents have fallen. The pace of rent growth has fallen down to 4.8%, and we're likely to see it continue to fall, probably down to that 3.5% range over the course of this year, which is around its long-term average. Talked about all this. Perth is still leading the pack. I think it's still growing at 9% or 8.8% as of the last 12 months, but that has slowed as well. I think it was 14% the year before. Okay. Yields are simply if you added up all the rent you get in a year and divided it by the property price, and expressed it as a percentage, that would be your yield. It's the percentage return you get from your property in rent. Yields in Darwin are pretty interesting, 6.7% yield, and that has been cash flow positive even throughout all those high interest rates. The rest of the market has been relatively, there's not much of a story here. Sydney always has the lowest yields, and the yields sort of increase as the population decreases. And that pattern there is pretty normal. If we look at housing supply, like how many houses are being built or approved, you can still see that houses are undersupplied. That dotted line here, that's the 10-year average approval rate for units, and you can see that we're down there. And this dotted line is the 10-year approval rate for houses, like the number of houses being approved, and you can see that we're also sitting below that as well. They are climbing a little bit, but they're 25% below the government target of 1.2 million homes in the next 5 years. So that's what Albo wants. He wants us to build 1.2 million homes over the next 5 years. We're 25% below that level. So I don't think that's going to get achieved. Good luck, Albo. All right, so where are we in the cycle? Running out of time here, I'm going to pick up my pace. So this is, I've used the Sydney market here because it's a good proxy. It's the biggest data set we have. It's the most robust data set, and it does tend to lead the market. So it's a good way to sort of judge the market timing. You can see that between these black kind of borders here, each one of those is a property cycle. So there's four full cycles here that we can see. And the cycle moves up in 3 distinct phases. It has this early cycle run up, it has a little breather, a mid-cycle consolidation, and then does this final run to the end, and then a correction. Again, early cycle run up, little breather, and final run to the again, and again, and again, and again. So most recently, this particular cycle started in 19. We saw that early cycle run up, we saw that breather, that mid-cycle consolidation, and we're now midway through that run to the end, which should end somewhere around 2027. We're likely now past the halfway mark, both in growth and in time for this cycle. We're heading into that final stretch, which is typically the most exciting part of the cycle. Usually we'll see growth in that 20% range or thereabouts for 2 to 3 years. We may see a slightly more muted cycle this time. It did run up very, very hard in 21 because the RBA used QE for the first time. And we saw that sharp spike in property prices. So maybe it doesn't hit those 20% growth levels nationally. Maybe it hits 15%, but it's still a spectacular amount of growth. And that cycle top is also aligned with the liquidity cycle top, that graph that we saw before. If you average 2 forecasting techniques, it tends to halve the error rate. And if both forecasting techniques are pointing to the same number at the end or the same result at the end, that's even better. So that's a pretty high confidence level there, that we'll see a market cycle top for most markets, or at least most of the major markets, in 26 or 27. All right, so what happens in 2025? We'll likely see 3 further interest rate cuts. We may even see more. The property market accelerates. We've seen early signs of that, with the auction clearance rate spiking, and we know that every single market starts with a rate cut, which we've just seen. Rent growth will slow. We'll probably see continued outperformance in Perth, Brisbane, and Adelaide, simply because they've entered this. Well, they started from a very low base, and they've also entered this market or this year with the most momentum. But all markets will rise. You print money, you let it flow through the economy. It doesn't just go one place, it goes everywhere. All markets will come up. Melbourne is interesting in that it will probably make a really late run due to lower prices. It has been held back, and it's now, I think it's the 5th cheapest dwelling price in Australia, which is a very unusual situation for Melbourne. It does look cheap. Both from a technical perspective and from a fundamental perspective, and we may see that run up very, very quickly later in the cycle. If not, it'll probably do a massive outperformance over the next cycle. That's Tony dying in the back.
Oh, dying in the background.
He's dead. Okay, we'll see continued sector into lower price property. And affordability will improve a little bit because as they cut rates, but they will quickly get eaten up by rising house prices or asset prices. So affordability is probably not, it's going to get better for a very short period of time, and it will get worse as the price increases from property outstrip the interest rate cuts. And as I said before, we may see a more muted cycle this time due to that very hard run up in 2021, where we saw quantitative easing for the first time and emergency cuts. All right, so that brings me to the end of my part. I hope you enjoyed it and learned something, and I'll hand you back to Tony.
Yeah, before I hand it back to Tony, I just want to say thank you, Gavin. Like I said, this is the third time I'm seeing and hearing this presentation in about a period of a month. I'm always learning from it. You are one of the few people I know that can take such dry information, make it really interesting. Not everyone's cup of tea, but I think it's really important for anyone who is currently invested in the market, looking to buy in the market, even renters, to understand where we're at the cycle, to understand how the global economy plays a part in our own local economy here, and our property market here is imperative. So yes, it's dry, but you manage with all that presentation to make it really interesting. What I always take out of it is how undervalued the Melbourne property market is. It gives me hope, and I keep telling my team the importance of them trying to get into the market and buy something, because it is still affordable compared to what you're seeing happening in places like Brisbane, Canberra, everywhere you've described except for Melbourne is booming, it feels like, at the moment. So that is my takeaway from it. If anyone's got any questions, sorry, what was that?
No, absolutely, you buy when there's blood on the streets. That's more, that's
you can
really...
afford to be buying right now in Melbourne. I keep saying I don't care what you're buying, buy, because I think Melbourne, like you said, will just continue to rise, and it is still so undervalued for one of the biggest cities in the country. If anyone's got questions, please pop them into the chat here. We'd love to answer any questions. This is all recorded if anyone does have to pop off. Tony, where are you?
I'm here. Just wanted to let you, give Gavin the raps he deserves.
Yeah, it does it well.
So I hope you all enjoyed that. One of the things for me, and Nurit's been around Blue Wealth for a long time. Gavin and I, on and off, have been working together for 20 odd years. And one thing that is very, very clear: all the information in the world is absolutely useless unless you actually take action. Yeah. So from my perspective, what I was saying at the beginning about buying a property every year for 23 years. That's the action that I took. I committed to a long-term strategy of building my asset base. And as Gavin just said, most of the time when I bought when the market that I bought in, everybody hated on, because that's when you buy. No one walks into a supermarket, sees something on special, and then decides to come back when it's full price. I'm like, I don't want to buy anything on special. I'll come back. So, essentially, markets like Melbourne, like some parts of Sydney at the moment, are on special. They're not going to get cheaper, and cycles will do what cycles do, which means that prices will rise. And our job is to hold your hand through that process, to make sure you're buying the right thing, to make sure you're getting into the market in the right place. So make sure you reach out. So I will put this up for those of you who are interested in having a meeting with us. The first meeting with us is complimentary, or all meetings with us are complimentary, unless you decide that you want to pay to buy something, which is a buyer's agency. But we have a list of approved properties in the research approved areas around the country that you can invest in. All right. And it won't cost you anything, because we get paid by the people who sell the property. All right. So if you're interested in having a meeting with us or having a discovery call talking about whether or not we're for you, point to that QR code and fill out your details, and Lisa will give you a call.
Whilst we're waiting for people to do that, I do have a question here from a couple of questions, actually, Mick.
We'll let you ask the questions, Nurit, and then we'll answer them.
Any predictions on percentage increases in units, house values over the next 12 to 24 to 36 months, Melbourne specifically?
Look, I love Melbourne. I've got a lot of my assets are in Melbourne, 7 or 8 of them. And if I had more money, I'd just keep buying down there, because the value is actually phenomenal. We never predict percentages, because anybody who does is only lying to you. But certainly we expect the Melbourne market to be positive. You saw the data that Gavin presented you earlier, saying that lower value properties grew at a higher rate than higher value properties. So obviously one of the factors that's driving growth in certain asset types is affordability. And we know that apartments are more affordable than houses. And so certainly our expectation is that they will perform well over the next 2 or 3 years. Or if I had to pluck a number, I'd love to see, 10, 15, 20%.
Yeah.
It might be more. I mean, I don't know.
Yeah, typically towards those last, almost always those last 3 years, 2 to 3 years of the cycle, we see somewhere in that 15% range per annum, every year. So that would be a normal. That's what we've seen every year or every end of the cycle since the 1960s.
So certainly in Melbourne, sooner rather than later, you're going to get those 2 or 3 really big growth years. Yeah. So Melbourne, if you have a look at its data over the long term, decades and decades and decades, has performed consistently well. So
8.2%.
don't
one of the best markets.
Don't get sucked into the short-term perception of that market right now. Yeah. If you zoom out, as Gavin always says, when in doubt, zoom out. If you zoom out, it's an amazing city with a huge population, with significant population growth, with strong economy, and good jobs growth. And despite all the stuff you're hearing, it's still some very positive key factors that will drive growth down there.
Yeah. So sorry.
Sorry, keep going, Gavin. Sorry.
So we've actually tracked 140 years of data for Sydney and Melbourne. If like 140 years of data, we've seen like Great Depressions, Great Wars, like literally every bad thing that's pandemics,
oil crises, pandemics,
any bad thing you can think of,
wars, GFCs, everything.
And the market has averaged like 8% plus growth through all of that stuff. So you would have to say that whatever factors that drove it through that stuff, through those crises, it was still going to continue to drive it. The key
is don't overthink it.
So speaking of overthinking it, one of the biggest questions we get asked from buyers in Melbourne that aren't owner-occupiers looking to move into a specific property, are we buying house and land? Are we buying in the city? Are we buying out in the country? What is there a rule of thumb, or is it dependent on each individual? What do you have?
It depends on each individual. Yeah, because like if my budget is 450,000, well, then getting a house with some land in a growth area is probably going to be unlikely. Yeah, you're going to have to invest in an asset that you can afford. If your affordability is in the vicinity of 600 or 700, you might be buying a townhouse. If your budget is in the vicinity of 800 or 900 plus, then you could potentially buy, or then you'll be buying a house, or you have the opportunity to buy a house. What we know is that depending on where you are in the country, even if you've got $1 million, you might buy an apartment. Yeah, so we know that apartments, for example, in places like the Gold Coast and the Sunshine Coast over the last 2 or 3 years have had extraordinary growth and have grown more than any house in any other part of the country. So the research ultimately dictates where you should be buying at any particular price point, and that will vary from person to person. It was only a couple of years ago we were selling houses in Perth, 500 meters to the beach for 600 grand.
575.
575. There you go. So that's gone now. Yeah. So every given period will give us, what the research is telling us is the preferred asset to invest in at that particular price. But don't be afraid of apartments. I own a lot of them. Yeah.
One more question here. Affordability is a big concern for buyers. Do you see any trends in government incentives or lending conditions that might support investors in the near future?
Yeah, there's always first home buyer grants. They'll roll out these things that are, to help first home buyers. But ultimately, all those things, I think they fundamentally misunderstand markets, because all those things basically end up adding to the price. You give someone 20 grand as an incentive, the property price goes up by 20 grand.
I'll tell you, that's what happens. I'm going to say something controversial. If the governments knew what they were doing, and if they knew anything about property markets, they would never incentivize the buyer. They would only incentivize the seller, the developer.
Yeah.
Because if you want to keep prices at a reasonable rate and you want to make things affordable for people, you need more supply. Why do prices rise and rise rapidly? Because there's more demand than supply. There's more people than there are properties. If you start to build more and bring more onto the market, that will bring a nice even flow to the marketplace. And all of a sudden, there's lots and lots of property for people to buy, and there won't be that that intense demand and that drives prices. And governments have never got that right. The reality is, but imagine a Victorian Labor government coming out with a policy that said, hey, What we're going to do is we're going to incentivize these filthy rich developers and get them to bring more onto the market. There'd be uproar. Yeah. They'd burn down Parliament House. But the reality is, if you remove all of that political stuff, and you looked at the dynamics of what drives markets, that would actually be the smart play. Yeah. What we're doing now is we're giving incentives to buyers so we can create more buyers in a market where there's not enough stock, which of course is going to increase prices. Yeah.
Yeah, good point. One more here for me. For those who already own an investment property, what strategies should they be considering to maximize returns in the current market?
Make sure you got a good property manager. It's certainly number one. I know we recently moved a client.
That's massive. That's
Massive.
Yes.
So much, so important.
Massive.
I can tell you, we had a client recently and we moved them. I'm going to obviously pat Narit and her team on the back, but we moved one of our clients from another property manager to Motion, and Brooke renegotiated the rent and got the owner, our client, $100 a week more in rent. Now, fine, the market's been increasing and that's great. And that probably means $20 or $30 or $40 of that rent was probably due to be increased at that time anyway. But the fact that it went up $100 a week just recently, when that sort of massive spike period is over, means that it was underpriced for the last year or two, right? And so if you imagine that extra $60 or $70 a week is $3,500 a year, that's a significant amount of money. And then the other factor, of course, is make sure you stay close to your mortgage broker to ensure that your interest rate is as sharp as it could be. If you're getting the maximum rent and you're paying the minimum interest, that's obviously going to help you.
And I just want to add to that. We do have some renters that are on here, and so I do want to apologise to all our renters. Of course, our intention is not to increase prices and totally outprice you out of the market you're in, whether you're in Footscray or Ivanhoe. But the conversations we have to have with our renters is, on the other side, we've got our investors who need to be able to make their mortgage repayments and their OC repayments. And ultimately, what we're seeing in Melbourne in our local market is our investor landlords, when they're selling their properties, they are not selling them to other investors at the moment. They're being sold to renters and owner occupiers. And what that means is that the supply is even less. So our renters who are complaining about increases in the market in rent are only going to be in for more pain if we're not able to at least help our landlords in order to pay the mortgages. And most our owners, I know many of our landlords, they're not sitting there, as Gavin said, these rich people sitting there on multi-million dollars. A lot of them are just trying to do the best and make sure they're not relying on the government for their retirement.
Most of our clients,
for us, it's a fine balance. So you rent.
Most of our clients have one property. Yeah. And so what has been very, very popular over the last few years for those people that are renting, what has been very, very popular over the last few years is rent vesting. So I can't afford to buy a house in the suburb I live in. I'm happy to keep renting here and I can buy a house somewhere else where I can afford. So there are other alternatives to the one that was taught to you by your parents or the ones that you saw your grandparents implement. Yeah. The world's changing.
In many cases, that rent vesting is it's positive. It gives you extra money that you didn't have before.
Yeah.
It's cheaper than actually
financially. It's actually the smarter thing to do: rent and invest, because then all your debt is tax deductible. But we can have those conversations in the meeting with us.
All right, that's all my questions. Unless anyone has anything else, I'd like to thank you guys. Thank you, Blue Wealth. Thank you, Tony, Gavin, for your time, and thank you for those who have joined us. And if we can help in any way, please reach out and enjoy the rest of your day.
Thanks, everyone.
Thank you. Bye.
Bye.